Lesson 6. How to properly identify the direction of your next possible trade. In the last video, you learned the dual frame trade setup. You were probably a bit disappointed when you realized that you had to wait for so long and seemingly waste many valid trade signals that could have potentially been great trades. So it is important to understand that these conditions are there to exponentially increase your probabilities of success in a trade. Following these conditions will limit your losses, and yes, you will still have losses with the DFTS, but they will be reduced to a minimum. So let's re-examine the examples we used in the previous video. Yes, you're right. We could have caught the entire move had we taken the first sell signal, which in this chart I marked as invalid. But there was no way for us to know that that was going to be the top. People wrongly believe that the secret to trading success is to buy low and sell high, or to sell high and buy low. There is nothing further from the truth. This is so important that I feel I should clarify it here. If we were to explain trading success using those words, we would say that the secret to trading success is not to buy low and sell high, but to buy high and sell higher, or sell low and buy lower. Why? Because unless you are an extremely accomplished analyst with polished forecasting abilities, catching the turn is close to impossible. However, in a later video, we will discuss a variation to the dual frame strategy that would allow you to catch the turn at an even earlier stage. Using the dual frame top strategy as explained so far, we first need to identify the trend, not the trend change. Notice that the time we'd have entered these positions, the trend was still in its starting phase. It's rather important to point out that of the 3 valid signals that we spotted on this chart, 3 of them would have resulted in very successful trades, some worth more than 60 points. Now, remember in a previous video we drew a circle on one of the sell signals not marked as valid? That sell signal would have been a loser, and there is a reason for it. It was not a valid signal using our dual frame top system. So we need to understand what really constitutes a valid trade signal. But first, let's review the preconditions. The first step is to look at the reference frame. You do that to clearly and unequivocally identify the trend and determine the direction you'll be taking your next possible positions. This chart will be 5 times larger than the chart of which you will be taking your signals, because that's your trigger chart. Now remember, the trend is up when prices close above the 30 weighted moving average, and the slope of the moving average is pointing up. The trend is defined as down when prices close below the 30 weighted moving average, and the slope of the moving average is pointing down. So if prices close above the moving average, but the slope is down or flat, that close would be ignored. For our definition to be valid, the slope of the moving average must point in the same direction as the close. This is the same chart we used in our previous example as a reference frame, but this time I marked the valid and invalid closes. On the left side, you can see 8 bars closing above the moving average, but none of those closes were valid. The moving average was either still pointing down or at some point it was flat. Obviously, it was transitioning from down to up. During the transition, it became flat. But not every time that an average becomes flat, it changes directions. Sometimes it is just a pause, as you can see on the right side of the chart, where the closes that are above the average were also invalid. After being flat for a few bars, it turned back down. According to what you have learned so far in this course, when the moving average is flat, it defines the trend as sideways, and in top, we avoid participating in the markets during periods of consolidation. The first valid signal, pointed on the left side of the chart, is the 8th bar of that group. At that time, it was already clear that the moving average was not just turning, but it was indeed pointing up. On the right side of the chart, you can see several closes above the moving average, but they were all made while the average was still pointing down or it was flat. Hence, they too were invalid and the trend is still considered as down. Those are the requirements that make our trend definition valid. It helps us to identify the direction of a possible trade, long or short. But it does not signal that a trade should be executed, not yet. For that, you need a valid signal on the trigger chart.